There are 40 numbers on this screen and you only need 6. Hey, what's up? Welcome back to Chalk Talks with Coach B. Today, we're cracking open the options chain, that wall of numbers that stops a lot of beginners cold the first time they see it. If you're brand new to options in general, go check out the options basics playlist first. I'll link it in the description because today we're assuming you know what a call and a put actually do. And if you got questions as we go, drop them in the comments or come find me on the stream. All right, let's kill the overwhelm. Here's the first thing to understand. The chain is split down the middle, calls on the left, puts on the right, and right down the center is the strike price column. That's the spine of the whole thing. Everything else is just details about the contract at each strike. So let's say the stock is trading at $100 a share. The strike at 100 is at the money. That's right where the stock is sitting. Anything below 100 on the call side is in the money. Anything above 100 on the call side is out of the money. For puts, it flips. Above 100 is in the money. Below 100 is out of the money. Right? That's it. In, at, out. Now, let me show you the 6 columns that actually matter, because everything else on that chain, the Greeks, the theoretical values, all that, we'll get to in other episodes. Today, you just need 6. Number 1, strike, already covered, where the contract gives you the right to buy or sell. Number 2, expiration or days to expiration, DTE. This tells you how much time the contract is left. More time equals more premium. Less time equals less. I like being about 45 days out. That's typically where I like to be because you get a decent amount of premium without being too far out in the future. Number 3 and 4, bid and ask. This is where you actually transact. The bid is what buyers are paying. The ask is what sellers are asking. And here's the thing people miss. The spread between those two numbers is a real cost. If the bid is $1.50 and the ask is $2, that 50-cent gap, that's money you're paying just to get in. Wide spread equals a less liquid contract. You want to see bid and ask close together. Number 5, volume. How many contracts traded today? If volume is basically 0, the market makers know there's no competition and they'll widen that spread on you. You want volume. It tells you other people are actually trading this thing. Number 6, open interest. Similar to volume, but it's cumulative. The total number of contracts currently open and outstanding. High open interest means the contract has real participation. Low open interest means you might have trouble getting out cleanly when you want to exit. Okay, now let's read one row end to end. Stock is at $100. We're looking at the 105 call expiring in 45 days. That's out of the money by $5. The bid is $2.10. The ask is $2.30. Spread is 20 cents. That's pretty tight. This is a liquid contract. If I'm buying this call, I'll probably pay around $2.20 split in the middle. One contract controls 100 shares, so I'm putting up $220. Volume today is 800 contracts. Open interest is 12,000. Both are healthy. This is a tradable contract. Now, here's one more column worth knowing about once you're past the basics. Implied volatility, or IV. This is the market's forecast of how much the stock is expected to move. High IV means expensive options. Low IV means cheaper. We'll do a whole episode on IV, but just know that when you see IV spike, premiums spike with it. All right, downside scenario, and this is important. Let's say you find a contract that looks cheap. The ask is only 50 cents, so you think it's a bargain. But you look at the bid and it's 15 cents. That's a 35-cent spread on a 50-cent contract. You're paying 70% of the value just in spread. And volume, 40 contracts. Open interest, 200. This thing is illiquid, and you are going to overpay getting in and get crushed trying to get out. Wide spread on a cheap-looking contract is one of the most common ways beginners lose money before the stock even moves. So before you ever think about direction, before you think about whether the stock goes up or down, check the spread, check the volume, check open interest. Make sure you're in a contract that will actually let you trade cleanly. The chain has 40 numbers. You need those 6. Start there every time, and the rest of it starts making sense. That's it for today. If this helped, hit the like and subscribe, and drop a comment with what you want me to break down next. Good luck in the markets, no matter what stock you're into.